Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, this is Vijay Bhambwani here. I hope you're enjoying my videos and they are helping you become better traders and you're able to decipher the nuances of the market a little more better. In this video, I want to talk to you about how markets shrug off bad news, shrug off the bearishness, and when an average Joe, an average Aam Aadmi or a retail trader is succumbing to panic, why the markets spring back like a jack in the box and what really makes the market do that. A few days ago, I made a video about why the Ukraine war was a blip on the long-term radar and you should not be tampering with your long-term core investments in your portfolio which you have bought with a multi-year time frame, because this event too, like the proverbial saying goes, shall pass. Now, I want to share an anecdote with you. It's a real life anecdote, and those of you who are statistically minded can do some homework on this and actually become far better traders and investors particularly. You see, in the 1960s, the Second World War was done and over. The soldiers who had gone to the front had come back home and they were seeking jobs. And as is natural after a major war, there was a slowdown. In wartime, everything is being produced at peak capacity because there are shortages, but those capacities become unutilized and idle in peacetime. The soldiers may or may not be as qualified as they should have been because university students, semi-skilled people all get sucked into the armed forces. So there was a big recession in the United Kingdom, England, and the only institution that had surplus money to invest was the Church of England. No surprises there. And the Church of England wanted to time the market by investing its surplus into equities, but they did not want to run the risk of losing money on their investments. So they put out an advertisement in the papers that the church was looking for an economist who could invest money for God. And since it was episcopal dispensation or duty to God, the Church of England would not pay any remuneration to that economist because he was doing God's work, but he would be blessed by God because he would receive obviously coverage that he was handling the Church of England's money, and maybe he could get business elsewhere. Nobody came forward because sentiments were subdued and herd mentality ensured that pessimism said nobody would want to take that chance. One economist by the name of Edwin Coppock, C-O-P-P-O-C-K, Edwin Coppock, came forward and he said, I'm willing to do the work for God and I don't want any remuneration, but since God is asking the question, I want God to provide the answers for which the Church of England should provide unhindered access to its premises to me so that I can seek the answers, which the Church of England provided. So he started touring various churches and speaking to the priests who were in the confessional box. And he went and asked them as to what people were confessing about pain. Why was he asking about pain? Because a bear market is supposed to give you pain. So what he aggregated as an answer from many churches was that the biggest pain was that of a widow who had recently lost her husband, especially if she was not financially well provided for and if she had no children issues, especially a male issue who could look after her in her old age. So her insecurity and financial helplessness was extremely painful, and these widows would often come to the priest and confess that they were getting depressive thoughts, some were getting angry, some were basically losing their faith, etc., etc. Now, Edwin Coppock started also filling up questionnaires after interviewing these priests, and he asked them what was the average time that a widow was taking to get over her pain and come out of this depressive phase. To his surprise, and maybe not even a surprise, he found that an average widow was taking anything between 10 to 14 months to hit a bottom, as it is called in behavioral finance. When you're extremely depressed, you feel the world is something that you don't want to fight anymore, you want to give up. It is called hitting a bottom. So the widows were hitting a rock bottom where their mental state was concerned, anything between 10 and 14 months. And then slowly but surely they picked up the threads of their life and they started going about business as usual, or life as usual. So Edwin Kopach's hypothesis was that the biggest pain or the biggest depression that a human being could suffer was the loss of a near and dear one, especially a husband of a widow who is not well cared or well provided for financially. And if she could move on between 10 and 14 months, a bear market should not last beyond 10 to 14 months time frame. So those of you who've traded long enough, I've been trading these markets since 1986, and let's take the example of the last big bear market. Just go back in time and see when the bull market that started in 2003, how it ended on 8th of January 2008, and how a bottom was made in late October 2008 itself. Any prices for guessing what the time frame was? January 2008, October 2008. 10 months. 10 months. So if there is a long-term bear market, which this one was, it's between 10 to 14 months. If it's an intermediate bearish phase, it is 10 to 14 weeks. If it is a short-term blip on the radar, it is 10 to 14 days. So this is a period that you should be keeping a close eye on. As a matter of fact, the technical analysis community decided to honor Edwin Kopach by making an oscillator called the Kopach's curve or Kopach's oscillator. If you Google search it, you might even get formulas for Metastock and AmiBroker, AFL formulas for these two softwares, and you can see how Edwin Kopach's work, in spite of the fact that it's been more than half a century, is still helping investors to time the market more or less, not the exact bottom, but more or less make better informed decisions. So you can see that the market basically hits a rock bottom and then starts to brush aside all bad news. Remember the ISIS in 2014. Every time a video came out about a beheading by the ISIS warriors, you would see the market tank, and after the first 5, 7, 8, 10 videos maybe, the market shrugged it off and it said, okay, let's go back to business and we'll basically start focusing on everything else like inflation, currency, unemployment, corporate profits, etc., etc. This is precisely the underlying reason. Human beings tend to get over their grief, dust the grief off their collar and get back to life. Now, is 10 and 14 month time frame a line cast in stone? I don't think so. Do remember that in the 1960s, it was a pure delivery-based cash investment market. Come the 1980s and 1990s, the onset of derivatives has accelerated the pace of the market. So rallies are quicker, falls are quicker, they are much more vicious, but bottoms are also made faster. The cycle is getting compressed. Information flows faster. You can basically send a WhatsApp message to any part of the globe within a few seconds, or nanoseconds maybe. So you see, market cycles are turning smaller, and therefore markets tend to fall viciously, but time-wise the corrections are between 10 and 14 months, 10 and 14 weeks, and 10 and 14 days, if not shorter. Which is why I told you that the Ukraine war is not something that you should lose your sleep over. This too shall pass. As shall every decline in the market. Every downturn in the market too shall pass. Don't deviate from your long-term investment core portfolio blueprint, because this too shall pass. On this optimistic notes, my friend, I bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Do Google search Copox curve and Copox oscillator and enrich yourself with this wonderful tool. In the comment section, good, bad or ugly, do let me know what you think of my work and what you would want me to speak about next. Help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. I thank you for your patience in watching this video. Till we meet again in my next. This is Vijay Bhambwani bidding goodbye for now. Take care. Have a profitable day. Thank you.